The Dow closing less than 1% from an all-time high. This ahead of tomorrow's big Fed decision. Wells Fargo Securities expects a knee-jerk bullish reaction to that news. Mike Schumacher is the firm's head of macro strategy. Knee-jerk bullish, but I guess that implies that you don't think that's the right reaction.
Probably not. Really, it's based on the idea, Melissa, that almost everyone we talk to thinks Jay Powell is going to come out and try to talk down the idea the Fed is going to ease soon. So the bar is really high. How can he possibly top that? I doubt he can. And actually, if you want to look at a recent example, go back to December 1st. He had an appearance down at Spelman College, and he didn't really sound dovish, but the market said, well, he wasn't super hawkish, so was off to the races. Bond yields down, equities up. Maybe it's not as dramatic tomorrow, but something sort of like that, I think, is on tap.
Do you think that he will try to be super hawkish and just the markets just will not believe him no matter what he says?
The problem is he's not a super hawk. He'll try to be hawkish, but in his core, he's not really a hawkish guy, in my opinion. So it's difficult for him to try to make that point and drive it home. I think that's the issue.
Sorry, speaking of core, super core, which is one of the things they talk about watching very closely, that there seems to be some sort of reacceleration going on there. So we can talk about this number being cool, but the one number they seemingly look at is going the wrong way for them.
Yeah, super core is ugly. I mean, if you look at the annualized rate over the last 3 months, I know it's a mouthful, it's above 5%. Now, the Fed's target is 2. It's not 5. Even if you look at core inflation, same math, annualized 3-month rate, it's right around 3%. And in fact, it's been around 3% for the last 4 to 5 months. It's down a lot, but that really occurred during April, May, June, that time frame, not recently. So momentum, it's stalled.
So one thing tomorrow that I would expect we'll see a change in the statement is around financial conditions. So last time they mentioned that financial conditions were tightening. Clearly since they've been easing. So I would expect a language change. It seems like they're making this a smaller issue. It's not front and center. But, you know, if we saw bond yields continue to come down, stocks continuing to rally, you said that might be the knee jerk tomorrow. When does it become a front and center issue to them, or do you think it does?
It's becoming a bigger concern. And when you think about bond yields coming down a lot, real yields in particular, that's the basic barometer of how tight policy is. So just to frame that a bit, when you look at the 10-year Treasury, real yields about 2%. And it's down from 250 plus not that long ago. That's a big move. It's still tight, but not nearly as tight. So the market's doing a lot of lifting for the Fed. But does the Fed want that lifting done right now, or would it rather wait 3 months? That's the big question.
Mm-hmm. So what's going to be the most important data for you? What do you think is the most telling?
It's the press conference tomorrow. No question about it. So statement, fine, couple words change, what have you. The dots are sort of interesting, but it's going to be what Jay Powell says and how the market really takes that. That's where the action is for us, Karen.
But it really sounds like no matter what Jay Powell does, he's going to be interpreted as dovish. And with seasonality working in the bulls' favor at this point, it seems like we're just going to be off to the right, which is back to the knee-jerk.
It's tough. It's tough for him. He's managed to out-hawk the market once or twice maybe in the last year, but it's a pretty high bar to get over for him. So that, to me, is the big challenge.
Yeah. Anything in PCE that will change? Not PCE, sorry, PPI, which is the other part to the CPI, which will feed into, the Fed's preferred gauge of inflation, PCE, to piece it together and get the PCE. Is there anything that we can learn?
Not too much, frankly. No. CPI told a pretty good story today, I think, as far as the overall picture's improved, but it's not really getting better faster. So I think that's the big takeaway for the Fed on the inflation front.
So where do you think rates are in 2 months or 3 months?
Yeah, I'd say pushing out toward the end of the first quarter, somewhat lower, but not a ton. So you think about the move in November. That was the express elevator straight down. Yeah. Now we're taking the escalator down kind of slowly. So 10-year Treasury yield, call it high threes, 390-ish, give or take. So 30 basis points lower than today. Not bad, but not a super aggressive move. And we think it's because people look at the comments, think about the comments from the central bankers. Even though they're not incredibly hawkish, they say, you know what, maybe they're not quite ready to ease. Maybe it's going to be a second half thing, and perhaps it's not April, May, maybe it goes out to September or something like that. So that easing in the market gradually gets pushed out, and that slows down the descent in yields.
So do you think that the descent in yields is positive for stocks at that point, or no?
Probably positive for risk in general. I mean, the recent reactions have been yields down, stocks up. I'll defer to Chris Harvey as far as the details, but that mechanism seems in place.
Okay.